On Wall Street, a powerful force operates in the shadows. BlackRock, a financial giant, holds unprecedented sway over global markets. With trillions of dollars under management, BlackRock's influence is undeniable. But at what cost does this immense power come? Is BlackRock a force for good or a threat to financial stability?
BlackRock is an investment management corporation. They manage money for individuals and institutions. Their portfolio includes stocks, bonds, and other assets. BlackRock's size and scope give them enormous influence. They can make or break companies with their investment decisions. BlackRock's reach extends far beyond Wall Street. They have investments in nearly every sector of the global economy. From technology to healthcare to energy, BlackRock's presence is felt everywhere. This vast influence raises concerns about their accountability and the potential for conflicts of interest.
BlackRock's power is amplified by Aladdin, their sophisticated risk management platform. Aladdin analyzes vast amounts of data to identify investment opportunities and manage risk. However, Aladdin's algorithms are shrouded in secrecy. Critics argue that this lack of transparency gives BlackRock an unfair advantage. Aladdin's influence extends beyond BlackRock itself. Many of the world's largest pension funds and institutional investors also use Aladdin. This means that BlackRock's investment strategies and risk assessments are shaping the decisions of countless other financial institutions. This concentration of power raises serious questions about market manipulation and systemic risk.
BlackRock's portfolio reads like a who's who of corporate giants. They own significant stakes in companies like Apple, Microsoft, and Amazon. BlackRock also holds large positions in major banks, energy companies, and pharmaceutical companies. This vast ownership gives BlackRock significant influence over the direction of these companies. BlackRock's influence is not limited to publicly traded companies. They also hold large positions in private equity and real estate. This means that BlackRock has a say in everything from the development of new technologies to the construction of new homes. Their reach is truly global and all-encompassing. Section 5. The Architects of Power. Who controls BlackRock? Larry Fink, BlackRock's founder and CEO, is the face of the company. He has been at the helm since its inception, guiding it through various financial landscapes. Fink is a Wall Street veteran with a reputation for being a shrewd investor. His strategic decisions have often set industry standards and influenced market trends. Over the years, he has amassed a personal fortune estimated to be in the billions. His wealth is a testament to his financial acumen and leadership skills. Fink's influence extends beyond BlackRock. He is a key figure in the financial world, often shaping policies and strategies that affect global markets. He is a trusted advisor to governments and central banks around the world. His insights are sought after in times of economic uncertainty and policymaking. While Fink is the public face of BlackRock, the company is ultimately owned by its shareholders. These shareholders play a crucial role in the company's governance and direction. The largest of these shareholders are institutional investors like Vanguard and Fidelity. These firms hold significant stakes and have a vested interest in BlackRock's performance. These firms manage trillions of dollars in assets and have significant influence over corporate America. Their decisions can sway markets and impact the economy. The interconnected nature of these financial giants raises concerns about collusion and a lack of competition. The concentration of power in a few hands can lead to systemic risks and ethical dilemmas. As BlackRock continues to grow, understanding who controls it and how it operates becomes increasingly important. The company's reach and influence are vast, making it a pivotal player in the global financial system. Section 6. A conflict of interest. BlackRock's dual role. BlackRock's business model presents inherent conflicts of interest. As an asset manager, their primary responsibility is to maximize returns for their clients. However, their vast ownership stakes in many companies create a conflict. BlackRock may be tempted to prioritize their own financial interests over those of their clients. For example, BlackRock may be reluctant to vote against management proposals at companies where they are a large shareholder. This is because doing so could hurt the value of their holdings. This conflict of interest raises questions about BlackRock's commitment to corporate governance and their fiduciary duty to their clients.
Section 7. Too big to fail. The systemic risk of BlackRock. BlackRock's size and interconnectedness pose a significant systemic risk to the global financial system. With over $9 trillion in assets under management, BlackRock is the largest asset manager in the world, and its influence extends across various sectors and markets. If BlackRock were to experience a major financial crisis, it could trigger a domino effect that would ripple throughout the entire market. The firm's extensive holdings mean that a sudden sell-off could destabilize prices across multiple asset classes. This is because BlackRock's failure would likely lead to a fire sale of assets, which would drive down prices and cause panic among investors. The interconnected nature of global finance means that the impact would not be confined to one region or market. The 2008 financial crisis demonstrated the dangers of too-big-to-fail institutions. During that period, the collapse of major financial entities led to widespread economic turmoil and required significant government intervention. The collapse of Lehman Brothers, a major investment bank, sent shockwaves through the global economy. It highlighted the vulnerabilities within the financial system and the potential for systemic risk. BlackRock is even larger and more interconnected than Lehman Brothers was at the time of its collapse. The firm's vast network of investments and its role in financial markets make it a critical player in the global economy. This makes the potential consequences of a BlackRock failure even more dire. The systemic risk posed by such a large and interconnected institution underscores the need for robust regulatory oversight and contingency planning to mitigate potential crises.
Section 8. The erosion of competition, BlackRock's dominance. BlackRock's dominance in the asset management industry is stifling competition. Their vast size and resources allow them to offer lower fees and attract more clients than their smaller competitors. This is leading to a consolidation of power in the hands of a few mega asset managers like BlackRock. This lack of competition can have negative consequences for investors. It can lead to higher fees, fewer investment choices, and less innovation. It also gives BlackRock outsized influence over corporate America. This is because they are often the largest shareholder in many companies and have the power to sway management decisions. Section 9. An opaque giant transparency concerns at BlackRock. Despite their immense power, BlackRock operates with a surprising lack of transparency. Their investment strategies, risk management practices, and lobbying efforts are often shrouded in secrecy. This lack of transparency makes it difficult to assess the true impact of BlackRock's activities. Critics argue that BlackRock's lack of transparency is intentional. They say that BlackRock wants to avoid public scrutiny and regulation. This lack of accountability is particularly concerning given BlackRock's influence over critical sectors of the economy.
Section 10. The future under BlackRock's watch. BlackRock's power and influence are only likely to grow in the years to come. As more and more money flows into passive investment strategies, BlackRock is well positioned to benefit. This is because they are the largest provider of exchange-traded funds, which are a popular type of passive investment. This continued growth will give BlackRock even more control over the global economy. It is important to consider the implications of this power and to demand greater transparency and accountability from BlackRock. The future of finance may very well be shaped by the decisions of this financial behemoth. Section 11. A call to action, rethinking financial power. BlackRock's dominance in the financial world raises profound questions about the concentration of power in the hands of a few corporations. This concentration not only affects the financial markets, but also has far-reaching implications for the global economy and democracy itself. It is time for a serious conversation about the role of these financial giants and the need for greater regulation and oversight. We must consider how their influence shapes policies and impacts everyday lives, from housing markets to retirement funds. We must demand transparency from BlackRock and other mega asset managers. Transparency is crucial for ensuring that these entities are held accountable for their actions and decisions, which can have significant consequences for millions of people. Their investment decisions and lobbying efforts should be open to public scrutiny. By shedding light on these activities, we can better understand their motivations and the potential conflicts of interest that may arise. We must also consider measures to promote competition in the asset management industry. A more competitive environment can lead to better services and lower costs for consumers, as well as reduce the risk of systemic failures. This could include breaking up large firms or limiting the amount of assets they can control. By doing so, we can prevent any single entity from becoming too powerful and ensure a more balanced and resilient financial system. The future of our economy may depend on our willingness to challenge the status quo and rethink the way financial power is structured. We need to explore innovative solutions and bold reforms that can create a more equitable and sustainable financial landscape. We cannot afford to be passive observers as a handful of corporations amass unprecedented wealth and influence. Their unchecked power can lead to economic disparities and undermine the principles of fair competition and democracy. The time for action is now. We must seize this moment to implement meaningful changes that can safeguard our financial future and ensure that power is more evenly distributed across the economic spectrum.